Sorry, he's getting in. You need the meeting password?
You need, are you talking to me, Marissa?
No, Ben, he's just getting in now. Good? Okay. That's weird. It's saying on his phone that he's in. Oh, there he is. Okay. I was like, he wasn't showing up. All right, ready?
Yes.
Okay. Good afternoon, everyone. My name is Marissa, and I will be your host and administrator today. Welcome to the January 2024 First Friday webinar. Today's presentation is titled, Turning an Uncertainty into an Advantage. Our prepared comments today will cover what's ahead for the U.S. economy's growth, inflation, and U.S. Federal Reserve's most likely course of action. This session will be recorded as other families who are unable to attend have asked us for the recording. Please note we will not record your questions as privacy is always a top priority for our firm. One more update for all family office members and participants today. We have started to summarize our First Friday discussion each month in a publication titled Footnotes. The Footnotes publication will include a summary of each topic, along with most of the supporting slides from the presentation. It will be available on our website, along with a recording of our webinar, approximately 5 days after the First Friday presentation is completed. Alternatively, if you'd like us to send you a copy, call us or send us an email and we will send one to you. Our prepared remarks today will be approximately 15 minutes long, with some time left over to cover questions from the participants. If you have already sent us your questions, we want to thank you. Your questions truly help us understand what topics are most important to each family we serve. If new questions arise from the content of today's presentation, please either send the question along by typing your question into the chat box at the bottom of your screen, or write it down and raise your hand by clicking on the icon at the bottom of the screen. We will do our best to get to your question at the end of the prepared comments. One final note, please remember to mute your device's microphone and stay on mute unless you have a question. Background noise is audible and distracting. With that said, let me turn the presentation over to Stephen Abernathy, who will provide today's commentary.
Welcome, everyone. I'm Stephen Abernathy, and this is the January 2024 First Friday meeting for all of our family office members. We've now had 15 webinars, and all of them are available on our website if you'd like to go back and see how we've interpreted the economic signals while doing our best to cancel the noise over the last year plus. We started this webinar series because we sensed, as I'd said last time, headwinds on the horizon, and we were pretty worried. However, fast forward to today, our goal is to welcome 2024 with a fresh outlook based on the most recent data. I guess we want to make a point to focus on signals and ignore the noise and try our best to make intelligent decisions based on facts and data offering information about the likely future to come. We thought it would be helpful to clear up some of the uncertainty which confronts us today by answering 6 of the best questions we've received over the last year. And by the way, as Marissa said, if these questions or the answers we offer generate additional questions, or if they aren't, or if the answers aren't sufficient, or you have attendant questions, please send us your questions or in the chat box below, or raise your hand, and Marissa will be sure to bring it up at the end of the meeting. So the question we want to start with today, or the questions are, what does 2024 have in store? What are the unknown risks we're dealing with today? Is the U.S. Federal Reserve winning or losing the inflation battle? How should we invest or allocate capital while guarding against significant downturns? And a special kind of option here is which investments offer the best risk reward ratio based on current data. And then lastly, the question every self-respecting analyst asks is what would have to happen for you to admit that you were just dead wrong? So what does 2024 have in store for investors today? Here are the facts. The US stock market should be priced at 15 times earnings. It's priced at almost 20 times earnings today. This means the market is 25 to 40% overvalued based on expected 2024 earnings. However, it's quite possible the 2024 earnings could be lower than the current expectations. Why would they be lower? Recession is likely in 2024. Debt repayments and interest charges on outstanding debt are going to put pressure on earnings and growth. Bankruptcies will increase in 2024. And we've discussed the fact that debt leverages outcomes both positively and negatively. The current amount of national debt combined with corporate debt, combined with personal debt, I believe will increase the outcomes and the volatility, both up and down. So this creates a really leveraged powder keg. And with the market already overvalued, it doesn't seem likely that even the positive occurrences are going to give us the leverage on the upside that are worthwhile to outweigh the downside of a disastrous event. Our base case this year is that markets go up and down with no gains in 2024. That's if we avoid a recession. If we have a recession, which, as I had said earlier, is our base case, it's the most likely pathway forward. We believe the markets will decline by 25 to 40%. That certainly is not consensus, and I'm not trying to be a glass half empty guy. I'm just telling you that things can happen. Here's the bad news. Even if we have a recession, equity portfolios are going to decline without any improvement in the significant amount of debt in our system. The U.S. Federal Reserve is going to cut rates, and the U.S. administration may also increase liquidity in an attempt to fend off or to make it a softer recession. Each of those actions is going to increase our debt load. Our real fear is that the increasing debt load is going to lessen our 2024 recession, yet the stimulus used to lessen the 2024 recession, as I said, will make the following recession much more damaging. The bottom line is that this debt overhang is going to remain an overhang for as long as it exists. It's going to reduce U.S. economic growth as interest payments take priority over growth expenditures, and eventually this is most likely to end very badly. In summary, 2024 is likely, or in 2024, it's likely that we're going to have a recession. S&P earnings will not grow by the 10% priced into current valuations, and the value of stocks will either turn down or end the year with little or no gain. The U.S. Federal Reserve will cut rates to lessen the recession, yet the unintended consequences of increasing our debt will be realized in one of the next recessions, making each recession to come more severe. Next, what are the known risks confronting investors today, and what's being possibly overlooked by the capital markets? Well, I think the best answer is, as always, there are many more risks possible than the one or the few risks which will become a reality. So let me just cite the most likely risks and the ones which are currently priced into the current market valuations. So currently, the US stock market is pricing in earnings growth of more than 10% in 2024. With inflation slowing, wages rising, and the probability of a US recession in 2024, along with the reality that the US consumer will run out of spending capacity at some point in 2024, one of the main risks is just simple overconfidence by the investing public. We believe earnings will be roughly flat in 2024 if we avoid a recession. And if we have a recession, earnings could decline by 20% or so. The overvalued stock market is going to react by declining, and the decline will be significantly more, the price decline will be significantly more than the earnings decline in an attempt to realize fair value, to get back. We also live in a pretty troubled world today, and I'm not a geopolitical analyst, but the US elections currently have two candidates leading each respective party. The polling shows that 70% of the citizens in the United States do not want either of these candidates to run for office. That's probably a first. I shouldn't say that because I haven't been around for the last couple hundred years, but that's unusual. Our hope is that there emerges a candidate which can offer both sides of our political system a semi-agreeable alternative. If not, we expect civil outbreaks rivaling or exceeding those in 2020. We're in a precarious position. No one is interested in negotiating. And I personally believe that the outbreaks that could take place if either side wins with the current leaders of our respective parties, it could be bad. Additionally, as all of you know, we currently have two significant wars on 2 to 3 continents. As the global economy continues to struggle for growth, we expect more wars to emerge, and we expect the eastern portion of the globe to continue to divide from the western portion of the globe. This global division is going to incent restructuring of supply chains. It's going to incent changes in currency valuations. It's going to incent the risks of more significant global conflict. Historically, for 1,000 years or so, when economic challenges have accosted any economy, it's often settled by war. That's a scary prospect, especially with what's going on today and with the armamentarium, the armaments that we have available to us today. So the bottom line is, it's difficult for us to see a scenario where healing, fellowship, and solidarity overcome our differences. Yet we hope calm and intelligent heads prevail. Our next question is a pretty easy one. Is the US Federal Reserve winning the battle against inflation? And what are the most likely Fed actions? And what does it mean for the investing public? And the short answer for this is yes. The US Federal Reserve is slowing our economy, and inflation is also slowing, yet it's not going away, at least not yet. We believe the combination of abundant subsidies for rebuilding supply chains, energy transformation based on climate change, funding wars on two continents, and paying an estimated 1 trillion in interest payments on our debt in 2024 promise to make inflation much stickier than the market believes. So yes, the Fed really is winning the battle against inflation, yet the battle is likely to last a bit longer than the markets currently expect. What's the Fed's next move, and what does it mean for the investing public? The market has priced in a 90% chance of a rate cut in March 2024, as shown on this slide. We believe this is much too soon, although we do agree that the next move by the Fed is more likely to be a rate cut than a rate increase. As you can see from this slide, inflation continues its current trajectory, or let me pare that back. If inflation continues its current trajectory, the Fed will have to cut rates by over 2.5% in order to bring rates back in line with the historical risk-reward balance. If this scenario becomes reality, investors should be increasing the duration of their bond portfolios on any upward fluctuations in interest rates. So make sure that if you believe the Fed is going to be cutting rates at any point in the fairly near future, even if it isn't as early as March, it's probably, our belief is somewhere around mid-year. Increase your duration a bit. So this brings us to our next question, which is more difficult to answer, as all investors have slightly different goals and, most importantly, different time frames. Based on the data and reliable signals today, how should intelligent investors allocate their capital to take advantage of the most likely scenario to come, while at the same time guarding against any significant downturn triggered by unforeseen events? So our belief is that due to the level of uncertainty today and the potential for magnified outcomes due to the enormous amount of debt outstanding, most investors should focus on controlling risks first. That's probably not news to most of you, but it's really important to have maybe to hear this again and again and again. Most investors should try their best to remain patient until the risk-reward relationship becomes much more attractive. There's, as Warren Buffett says, there's nothing wrong with standing by and watching 30 pitches go by. If you're using the baseball analogy, you don't have to swing. So our counsel is to maintain a larger than normal level of diversification, as both uncertainty is high and systematic leverage is likely to create more volatility than the markets are priced for. Maintain a more significant commitment to low risk or riskless investments, as they are likely to generate more current income today than we've seen in the last 20 years. So that's a welcomed gift. Regarding risk capital, commit risk capital in high quality investments as close to book value or under book value, and focus on collecting income, as income may be the only return available on risk assets. And the reason for that is, obviously, we don't expect appreciation to become a reality until current valuations for risk-based assets, meaning stocks and preferreds and others, become more in line with historical levels. Next, which investments offer the best risk-reward ratio based on current data? So we believe, and most of you aren't going to be comfortable with this, but we believe that riskless U.S. Treasury bills, bonds, and notes, depending upon your time frame, offer an attractive risk-reward ratio today and provide a return which is slightly over the current inflation rate. Alternatively, for those seeking higher returns and who might be willing to accept some fluctuation in value over the short term, preferred stocks, common stocks, as I'd said earlier, near or under book value, which are paying significant dividends, are likely to become in vogue over the next few years. Keep in mind that these types of assets have been out of vogue for at least a decade. Income investing is coming back. We believe is coming back in vogue, and it couldn't be happening soon enough to us. Most of these income generating investments check the high quality box, they check the value based box, and the certainty of a return based box, similar to real estate investments, is also checked. And by the way, you get to, as all of you know, you get to own these assets without the day-to-day management challenges created by owning real estate. Just to finish that analogy. One more point, and it's an important point for all of you because everybody on this call is in a nosebleed level tax bracket. Most of these equity type investments offer tax advantages which do provide a higher after-tax yield than the strictly riskless investments of U.S. Treasury bills and other income-related investments. Keep in mind, the main considerations are your tolerance for risk, mainly the ability to emotionally handle the fluctuations that they're going to come with all stocks and all public equity investments, and two, your time horizon. If your time horizon is 5 years or more, the combination of low risk and no risk investments, along with high quality, high dividend paying equities, is likely to provide an investment portfolio with returns commensurate with much higher risk, higher volatility, and it will include tax consequences on top of it all. So lastly, the humbling yet much needed question to be answered is, what would have to happen for you to be convinced your outlook is wrong? Well, as I'd said earlier, it's the question each of us need to ask before making any significant decision, because it's important to understand that what may take place if you're wrong at times is worse than staying the course with your current strategy. So here's the answer. Several events would need to take place to convince me our outlook is wrong. Firstly, there would have to be a working solution to the reduction of our U.S. debt. This would likely involve a significant reduction of social services and or along with increases in corporate taxes, income taxes, and inheritance taxes. As all of you know, this is called the third rail of politics, and despite it being the most likely solution, it is the least likely topic a politician could run on and have any chance of winning an election. After all, who wants to pay more in taxes while receiving less in social services? So we're going to have to find that diamond in the rough that can do both of those things, or we're going to be in trouble. And by the way, as all of you attending this call probably know, there's no solution even being talked about. Next, a new candidate for president would have to emerge that's able to appeal to the middle of our political system, yet able to tackle our physical debt, our deficit, and equally important, our geopolitical situation and stance in the world. We really need someone who can heal our position as a global leader, who's interested in finding win-win situations as opposed to structured relationships in which only the US wins at the cost of everybody else. And this is not a political statement. I'm not dissing any current or former politician. I'm just saying we need somebody who is acceptable on the global stage. And I might say that while every cell in my body hopes for this person to emerge, I realize that hope isn't a strategy. However, crossing my fingers and praying each day, it probably can't hurt. Finally, if we could put together an administration that's able to generate growth in our economy significantly over and above the 1.5% rate our steady state economy is currently slated to grow, we might find our way back to repaying some of our debt and maintaining our position in the world's leading economy. It's incredibly unlikely for this to happen. Our debt repayments are slated to be approximately 1 trillion per year in 2024 and rising each year after. While our social obligations, along with defense spending and healthcare costs, are going to create some incredibly difficult decisions over the next few years, in our opinion. Absent these three miracles, it seems as if the probability of our current expectations are a bit ahead of themselves, and our counsel to all family office members remains conservatively allocated. Let me stop here and take a moment to check with Marissa to see if there are any questions or if these answers have generated any additional questions before we end our January 1st Friday meeting. Marissa?
No questions have been received in the chat yet, so no questions.
Okay. For most of you, please let me wish you a wonderful 2024 full of interesting events and positive surprises, and we'll see you in February. Bye now.